Dear viewer, if you're ambitious, it's very likely that when you started your professional life, you dreamed of owning a home that fits your lifestyle. But since you probably didn't have enough money, that dream felt out of reach. Wait, just kidding. Luckily, there are systems in place today that allow you to own your dream home, not tomorrow, but today thanks to what's known as installment plans. With installment plans, you can buy practically anything, whether it's expensive or cheap, essential or luxury. This has greatly increased people's access to a more comfortable lifestyle. In this video, we'll focus specifically on homeownership through installment payments, commonly known as mortgage financing. This kind of financing was at the heart of the 2008 global financial crisis. In the US, the modern mortgage system began after the Great Depression of 1928. That's when the concept of the mortgage emerged, a loan secured by the property itself. In simple terms, if you don't pay, the bank can seize the house and sell it to recover its money. This system significantly boosted homeownership. In 1940, only 40% of Americans owned homes. By 1980, that number had climbed to 65% thanks to mortgage financing. Financial institutions known as savings and loans, SNLS, were foundational to mortgage financing in the US. However, they ran into regulatory and financial trouble, leading many of them to shut down. To keep the system alive, Congress allowed banks to sell their mortgage loans to outside investors. This opened the door to mortgage-backed securities, MBS. Here's how it worked. Banks bundled their mortgage loans and sold them to investment banks. These investment banks then broke the bundles into smaller shares and sold those shares to investors as securities. Investors believed these were safe investments because they were backed by real estate loans. But as some borrowers began to default, investors became divided. Some wanted safer investments with lower returns, while others chased higher returns even if it meant taking on more risk. This led to the creation of a complex system called collateralized debt obligations, CDOs, which categorized debt based on the borrower's ability to repay. CDO ratings were assigned by credit rating agencies, namely Moody's, Standard & Poor's, and Fitch Ratings. With the introduction of CDOs, things got a bit complicated. Debts were rated from super safe to extremely risky. The safer the debt, the lower the return. The riskier the debt, the higher the return. This encouraged banks to loosen their lending standards because risky loans were in high demand by investors chasing bigger profits. Some institutional investors, like pension funds, were legally required to invest only in safe products to protect the savings of millions of people. This is when insurance companies, particularly AIG, stepped in. They offered to insure these investments in exchange for a cut of the returns. This gave rise to a new financial product called Credit Default Swaps, CDS, essentially insurance contracts on investments. This made investors feel even more secure and more willing to take risks, assuming they'd be protected if loans failed. Between 1996 and 2006, home prices doubled, making MBS look like a great investment. And since prices were rising, banks weren't too concerned about borrowers defaulting. If someone couldn't pay, the bank could just repossess the house and sell it for more. In fact, it became more profitable for banks if borrowers did default. That's when creditworthiness became irrelevant. Practically anyone could get a mortgage, just with higher interest rates. Enter ninja loans. No income, no job, no assets. These were loans to completely unqualified borrowers, many of whom couldn't afford to pay them back. People were misled. The interest rate they ended up paying was higher than what was advertised. This is known as predatory lending. The result? Massive defaults. And when banks seized the properties, they found themselves with too many houses and not enough buyers. The surge in defaults meant banks were sitting on thousands of homes. With supply far exceeding demand, housing prices plummeted. Between 2006 and 2010, home values dropped by about 30%. Even responsible borrowers saw their homes lose value. A house they bought for $1 million might now be worth $700,000, but they were still making payments based on the original price. Many of them just stopped paying and returned the homes to the banks, then took out new loans to buy cheaper homes. That only increased the housing supply and drove prices down further. At this point, financial institutions and investment banks stopped buying mortgage debt. Banks were stuck holding bad loans and too many homes they couldn't sell. Many went bankrupt. Investors in MBS lost billions. The entire mortgage-related securities market collapsed. Remember those insurance companies? They had insured these investments, but CDS contracts weren't regulated. Insurers hadn't considered the possibility of mass defaults. As a result, these companies also started to collapse. AIG, the largest insurer involved, was hit hardest. The US government had to bail it out to avoid a global catastrophe. During the crisis, several major American financial institutions went bankrupt or nearly collapsed. Most notably, Lehman Brothers declared bankruptcy on September 15, 2008, after failing to secure a buyer or government aid. With over $600 billion in assets, it was the largest bankruptcy in US history. Lehman's fall triggered global panic. Washington Mutual, the largest savings bank in the US, was shut down by regulators in September 2008, and its assets were sold to JP Morgan Chase. Bear Stearns faced a liquidity crisis in March 2008. It was acquired by JP Morgan Chase with help from the Federal Reserve. It didn't officially declare bankruptcy, but it vanished as an independent firm. Merrill Lynch, nearly collapsed in September 2008, was bought by Bank of America in an emergency rescue deal. In total, 25 small to mid-sized US banks failed in 2008 alone, according to the FDIC. By 2011, 75% of mortgage lenders that existed in 2006 were gone. These collapses changed the face of the US and global financial sectors, leading to strict reforms and increased regulation. Economic and social consequences between 2008 and 2010, the US lost 8.8 million jobs and unemployment peaked at over 10%. More than 10 million American families lost their homes between 2006 and 2010, triggering massive social crises. Around 9 million Americans lost their health insurance due to job loss. US pension funds lost an estimated $2.4 trillion, affecting millions of retirees. From 2007 to 2009, the US stock market lost $8 trillion in value. The New York Stock Exchange lost half its market value during the crisis. According to a 2018 Federal Reserve study, the average American lost $70,000 during the crisis. A global ripple effect because the global economy is deeply interconnected. The crisis spread beyond US borders. The UK government spent £850 billion between 2008 and 2009 to save its financial sector. In October 2008, the London Stock Exchange lost £90 billion in a single day. In Singapore, a government investment company lost $80 billion. In China, 20 million workers lost their jobs due to the recession and reduced global demand. The dark side, manipulation and recklessness, the crisis exposed terrifying practices. Investment banks were buying risky debt from other banks, then paying credit rating agencies to give it favorable ratings so they could sell it as safe to investors. Worse, some banks were betting against the very investments they were selling. They knew these loans would fail and profited twice, once by selling risky investments as safe, and again by wagering on their collapse. Even more shocking, insurance companies were selling protection, CDS contracts, on investments they didn't even own. This meant anyone could bet on someone else's investment failing. So again, investment banks had an incentive for these products to fail because they could collect on the insurance. This turned the system into a rigged game. Banks handed out bad loans knowingly, sold them off, and bet against them, profiting at every step. Were these institutions ever punished? Of course not. The US government had to intervene to prevent total collapse. These institutions were too big to fail. If they had gone under, the entire economy would have gone with them. So Congress approved massive bailouts. Governments and central banks acted quickly. The US government injected trillions of dollars into the economy, including a $700 billion rescue plan for banks and financial firms. The Federal Reserve slashed interest rates to near zero to stimulate recovery. The Dodd-Frank Act introduced sweeping reforms to regulate banks and reduce future risks. Other countries, including those in Europe, took similar actions to stabilize their financial systems. Use installment plans wisely. Installment plans and mortgage financing are powerful tools that can help you achieve your dream of homeownership. But they must be used wisely. Don't borrow more than you can afford. Always understand the real terms and interest rates of any loan. The 2008 crisis taught us a hard lesson. Mortgage financing should help build a stable life, not lead you into financial ruin. If you enjoyed this video, give it a like and subscribe for more economic and financial topics. And don't forget to share your thoughts in the comments. We'd love to hear from you. Thanks for watching.